Title: The Intelligent Investor, a comprehensive guide to mastering investing. Welcome back to the channel. Today we're going to embark on a journey through one of the most legendary investment books ever written, The Intelligent Investor by Benjamin Graham. This book has stood the test of time and is still regarded as one of the best guides for anyone serious about building long-term wealth through smart investing. Now, Graham's philosophy isn't about quick wins or taking huge risks. It's about a disciplined, patient approach to investing that minimizes your risk while maximizing your long-term returns. If you're wondering how to apply these principles in today's fast-paced, often volatile markets, stick with me. Today I'll be walking you through 5 major takeaways from this timeless classic, and I'll be explaining how you can use them to shape your investment strategy. Before we dive in, if you're new to the channel, make sure to hit the subscribe button and click the bell so you don't miss any future videos. Let's get started. Takeaway 1. Meet Mr. Market. Alright, let's start with one of the most iconic metaphors in The Intelligent Investor, Mr. Market. Imagine this. You've invested $1,000 in a business. Now, every single day, this unpredictable guy named Mr. Market comes knocking on your door. He has an offer for you. He's willing to buy your share of the business or sell you more, depending on his mood that day. Some days, Mr. Market is feeling really optimistic and offers you $2,600 for your share. Quite the markup, right? But on other days, he's in a bad mood and thinks your share is only worth $500. His mood swings have nothing to do with how well the business is actually performing. They're entirely driven by his emotions. Why Mr. Market is important? Now, the key takeaway here is that Mr. Market represents the stock market itself, its volatility, its unpredictability, and how its prices fluctuate based on external factors like news, rumors, and general market sentiment. But, and this is crucial, just because Mr. Market comes to your door every day with his opinion, doesn't mean you need to act on it. This is one of the biggest lessons Graham offers. Don't let the market's day-to-day volatility dictate your investment decisions. You don't have to accept Mr. Market's offer every day. You're free to make your own judgments about the value of your investments. The price of a stock doesn't always reflect the underlying value of the business, and as an intelligent investor, it's your job to focus on that true value rather than the fluctuating price tag. The emotional component. Why is this so important? Because most investors fall into the trap of following the market's emotions. When prices rise, they get excited and buy at inflated prices. When prices fall, they panic and sell at a loss. But Benjamin Graham argues that this is exactly the opposite of what you should do. Let's talk about an example to drive this point home. During the dot-com bubble in the late 1990s, tech stocks were soaring. Everyone was rushing to buy shares of companies like Pets.com and Webvan, convinced that they were going to be the next big thing. Mr. Market was offering sky-high prices for these stocks, and many people bought in because they didn't want to miss out. Fast forward to 2000, and the bubble burst. Many of these companies, which had no real business model or profits to speak of, collapsed, leaving investors with huge losses. In this case, Mr. Market was wildly over-optimistic, and those who listened to him paid the price. On the flip side, during the financial crisis of 2008, stock prices plummeted across the board, even for solid, profitable companies. Mr. Market was in a deep depression, offering shares of great companies at rock-bottom prices, but many people were too scared to buy. Those who kept a cool head and bought during the downturn, when everyone else was selling, ended up making significant gains over the next decade. How to respond to Mr. Market? So what's the right way to respond to Mr. Market? Graham says that, as an intelligent investor, you should only act when it benefits you. If Mr. Market is offering you a price that's far above the actual value of your stock, that's a great time to sell. If he's offering a price that's well below the company's intrinsic value, that's the time to buy. And if his offer doesn't meet your standards, just ignore him and move on with your day. Remember, the stock market doesn't force you to act. It simply offers you opportunities. The best investors are those who can separate their emotions from their decision-making and view these opportunities objectively. If you can do that, you'll already be ahead of most investors. Practical application. Let's talk about how you can apply this in real life. We're constantly bombarded with financial news, stock prices, and expert predictions. It can be overwhelming, right? But just because the market is open every day and you can trade anytime with just a click on your phone doesn't mean you should. In fact, frequent trading is one of the biggest reasons why so many individual investors underperform the market. Instead, take a step back and think like an owner of the business. Before you buy a stock, ask yourself, am I comfortable owning this stock for years, even if the price goes down in the short term? If the answer is yes, then you're thinking like an intelligent investor. And if you're already invested, don't let short-term price fluctuations push you into making a rash decision. The more detached you can become from the market's daily ups and downs, the better your investment results will be in the long run. Focus on the underlying value of the companies you invest in and ignore the noise. Takeaway 2: How to invest as a defensive investor. Now, let's move on to takeaway 2, which is all about the defensive investor. According to Graham, there are two types of investors: the defensive or passive investor and the enterprising or active investor. Let's focus on the defensive investor for now. Who is the defensive investor? A defensive investor is someone who wants to grow their wealth over time, but doesn't want to spend a lot of time or effort actively managing their portfolio. This is where most people fall, and there's nothing wrong with that. In fact, Graham believes that most investors are better suited for a defensive strategy because they simply don't have the time, knowledge, or inclination to do the intensive work that comes with being an enterprising investor. So, what does a defensive investor's portfolio look like? Graham recommends a simple, balanced approach. Your portfolio should be made up of a mix of stocks and bonds, typically around 50% stocks and 50% bonds. This balance helps you manage risk while still giving you exposure to the growth potential of the stock market. Rebalancing your portfolio. One of the key principles for a defensive investor is rebalancing. Let's say you start with that 50-50 mix of stocks and bonds. Over time, the value of your stocks might rise, so they make up 60% of your portfolio, while bonds make up only 40%. At that point, you should rebalance by selling some stocks and buying more bonds to get back to the 50-50 ratio. Why is this important? Rebalancing forces you to sell high and buy low. When your stocks have risen in value, you sell some and lock in those gains. When stocks have fallen, you buy more at a lower price. This disciplined approach helps you avoid the emotional traps of buying high and selling low, which is one of the most common mistakes investors make. Dollar cost averaging. Another great strategy for defensive investors is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the market's performance. For example, you could invest a portion of your paycheck every month into a diversified portfolio of stocks and bonds. By doing this, you spread out your purchases over time and avoid the risk of buying too much at the wrong time. When the market is high, your fixed investment buys fewer shares. When the market is low, the same amount buys more shares. Over time, this results in a fair average price for your investments. Diversification. Graham suggests owning 10 to 30 companies in your stock portfolio. This gives you enough diversification to protect yourself if one company or industry underperforms. But it also allows you to focus on high-quality companies that meet certain criteria. What criteria should you look for? Graham provides a set of guidelines for the defensive investor when choosing which stocks to invest in. These criteria are designed to help you find strong, stable companies that are likely to perform well over time. Size. Graham suggests investing in large companies. In his time, he defined this as companies generating more than $100 million in annual sales. Adjusted for today's inflation, that's about $700 million or more. Larger companies tend to be more stable and less prone to the volatility that smaller companies might face. Strong financial condition. Look for companies with strong balance sheets. Specifically, the company's current assets, like cash and receivables, should be at least twice its current liabilities, like debts and bills due. This ensures that the company has enough liquidity to weather short-term challenges. Consistent earnings. Invest in companies that have had consistent earnings growth over the past 10 years. This shows that the company has a stable business model and can continue to grow over time. Dividend history. Look for companies that have paid a dividend consistently for at least 20 years. This demonstrates a commitment to returning value to shareholders and suggests that the company is financially healthy enough to maintain its dividend payments. Moderate price-to-earnings ratio, PE. Finally, Graham suggests avoiding stocks with an excessively high PE ratio. A high PE ratio means that investors are paying a premium for the company's earnings, which could be risky if the company's future growth doesn't live up to expectations. Aim for a PE ratio of 25 or lower. Index funds, a modern solution for the defensive investor. In today's world, Graham's advice for defensive investors is often applied through the use of index funds. Index funds are mutual funds or exchange-traded funds, ETFs, that track the performance of a specific market index, such as the S&P 500. By investing in an index fund, you automatically get exposure to a diversified portfolio of stocks without having to pick individual companies. Index funds have a few major advantages for defensive investors. Diversification. With one purchase, you're invested in hundreds or even thousands of companies. Low fees. Index funds typically have much lower management fees than actively managed funds, which means more of your money stays invested and compounds over time. Simplicity. You don't need to spend time researching individual stocks. Just invest in an index fund and let the market do the work for you. Warren Buffett, one of Benjamin Graham's most famous students, has said that most investors would do well to simply invest in a low-cost S&P 500 index fund and hold it for the long term. This is a perfect example of Graham's defensive investing philosophy in action. Practical application for the defensive investor. Let's say you're a defensive investor. You've decided to allocate your portfolio 50% to stocks and 50% to bonds. Here's how you might implement Graham's principles in today's market. For your stock allocation, you could invest in a low-cost index fund like the Vanguard Total Stock Market ETF, VTI. This fund gives you exposure to a wide range of U.S. companies, from large corporations to small businesses. Alternatively, you could invest in individual companies that meet Graham's criteria. Large, financially stable, dividend-paying companies with reasonable PE ratios. For your bond allocation, you could invest in a bond fund like the Vanguard Total Bond Market ETF, BND. This gives you exposure to a diversified portfolio of U.S. government and corporate bonds, helping to reduce the overall risk of your portfolio. Once or twice a year, you would rebalance your portfolio by selling some of your stocks or bonds to maintain your 50-50 ratio. If the stock market has gone up, you would sell some stocks and buy more bonds. If the stock market has gone down, you would do the opposite. By following this strategy, you can grow your wealth over time while keeping your risk in check. Takeaway 3. How to invest as an enterprising investor. Now, let's shift gears and talk about the enterprising investor. If you're someone who enjoys digging into financial reports, analyzing companies, and actively managing your investments, this section is for you. Who is the enterprising investor? The enterprising investor is someone who is willing to put in the time and effort to research individual stocks, find undervalued companies, and take a more active role in managing their portfolio. This approach requires a deep understanding of financial statements, market trends, and individual company performance. It's not for everyone, but for those who have the time, knowledge, and interest, it can lead to above-average returns. Avoiding growth stocks. One of the first pieces of advice Graham gives to the enterprising investor is to avoid growth stocks. Growth stocks are companies that are expected to grow rapidly in the future, often because they are in fast-moving industries like technology. While these stocks can offer big rewards if the company's growth lives up to expectations, they also come with significant risks. The problem with growth stocks is that they are often priced based on very optimistic assumptions about the future. Investors may be willing to pay a high price for these stocks because they believe the company will continue to grow at a rapid pace. But if that growth slows down or doesn't materialize, the stock price can plummet. Graham's advice to the enterprising investor is to avoid chasing the next big thing and focus on value investing instead. What is value investing? Value investing is all about finding companies that are trading at a price below their intrinsic value. In other words, you're looking for stocks that are undervalued by the market. These companies may not be in the spotlight, but they have strong fundamentals and the potential for future growth. To identify these undervalued companies, Graham suggests focusing on a few key factors. Low price to earnings (PE) ratio. A low PE ratio suggests that the stock is trading at a lower price relative to its earnings, which could indicate that it's undervalued. Strong balance sheet. Look for companies with a strong balance sheet, meaning they have more assets than liabilities. This gives them the financial flexibility to weather tough times and invest in future growth. Consistent profitability. The company should have a track record of consistent profitability over several years. This shows that the business is stable and has a solid business model. Low debt levels. Companies with low debt levels are less risky because they don't have to worry about paying off large amounts of debt in the future. This gives them more flexibility to invest in growth opportunities. Dividends. Companies that pay dividends are often a good choice for value investors because they are typically more financially stable and committed to returning value to shareholders. Conclusion. So there you have it, 5 timeless principles from the intelligent investor that can guide you through the ups and downs of the stock market. Whether it's mastering your emotions, embracing a defensive or enterprising investment strategy, or always insisting on a margin of safety, Benjamin Graham's wisdom is just as relevant today as it was when he first wrote the book. Remember, investing isn't about chasing quick wins or following the latest trends. It's about patience, discipline, and staying true to sound principles, even when the market gets unpredictable. The key takeaway? Don't let fear or greed drive your decisions. Let logic and careful analysis guide you toward long-term financial success. If this video helped you understand the world of investing a little better, don't forget to give it a thumbs up and share it with others who might benefit. And if there's a particular concept or chapter from The Intelligent Investor that you'd like me to dive deeper into, leave a comment below. I'd love to hear your thoughts. As always, thanks for watching, and here's to making smarter investment choices.